Dustin Tibbetts with Passport to Wall Street, and today we're talking about playing volatility, but without playing volatility. So I'll explain. So normally when the stock markets get a little scary, wiggling around back and forth, traders go, well, let's go play volatility. Let me go make some money off of that. While the longer term investors are thinking, let me use volatility as a hedge in case things continue to be scary. Traders want to profit from it. And so I'm going to bring up the question today of, well, what if we don't want to play VIX, VIX Futures, the VXX, the ETF for volatility, or some leveraged ETF or something like that? What happens if someone says, I don't like that product. I want to play volatility, but I do not want to participate in volatility, the product. And so one real easy way to do that is to say, look, think about people getting fearful of the market. If people get fearful of the S&P 500, the VIX or volatility goes higher. Well, couldn't people get fearful of individual stocks as well? Maybe because of earnings or pending news or a sharp sell-off. And so the answer is yes, people can get fearful of individual stocks and also the VIX or just individual stocks in general. So one great example I want to share with you today is a recent trade of the week that we called, which was AKAM, Akamai Technologies. Now we talked about a simple way to just sell a put on this lesser expensive stock and to play for the stock to either go sideways or give us a little bounce. So far we got basically sideways because it did go lower from where we entered and has since recovered from that, but it really hasn't bounced yet. So we're getting this sort of sideways movement. Totally fine with us since we sold puts. Now, why would we choose to sell puts? If you look down here, this little graph on the, or little line on the chart is showing us the level of fear inside of this particular stock. And so what we did is when this stock sold off and people became more fearful of the overall markets as well as individual stocks such as ACAM, we said, look, volatility is higher here, which means we can get more money for any options we want to sell. It would be more costly for us to buy options, so that's why we suggested to sell the put in this case. And now we're hoping for volatility to relax. We want people to not be as fearful anymore. Option prices therefore become less expensive, which is what we want, or people then decide to come buy the stock. And so here's a great example of looking at what's known as the implied volatility relative to its history, right? We are not just saying it's at a high point right now, we're gauging it based on history. So we're looking back and saying the volatility relative to what's normal for this stock is high. If you were to simply look at a number and say the volatility is 0.476, that's close to halfway. One of us could make the argument that volatility was high. The other one could make the argument that volatility was not. And so anytime we see volatility, we don't just look at the number, we compare it to history to say, wow, look at this. It is high compared to its average. And so that's why we chose that trade. And so it's just a really cool way to look at individual stocks rather than the VIX. If you don't want to play the VIX, that's okay. Now you know you have options on stocks as well. You could choose to go and sell options on those stocks or buy stocks, buy the actual shares, knowing that things are more volatile there. So just a different way to take a look at playing volatility. I hope you enjoyed. I hope it makes you a profit, and we will talk to you soon.